Welcome to the Empowered Investor Podcast. Have you ever felt overwhelmed by the sheer volume of choices and voices telling you how to plan or invest for your future? With his straightforward approach, host Keith Matthews of Toulette Matthews & Associates cuts through the noise to help you create a winning action plan for you and your family. The decision-making framework discussed in this show can transform you and your investment experiences and will increase your odds of becoming financially secure. Learn more and subscribe today at tma-invest.com.
Welcome to the Empowered Investor Podcast. My name is Lawrence Greenberg. I'll be your host today, and I'm joined by my co-host, Jackson Matthews. Jackson, how are you?
Hey, Lawrence. I'm doing well. Super excited to be back on the show. I think we have a good episode today,
Yeah, I think this is a super interesting one. I've been excited to do something like this. It's evergreen. It's relevant for so many different people. What we're talking about today is going over all the investment accounts that investors in Canada have access to. We're going to walk through the types of accounts and how they work, who they're best used for, and common errors and misconceptions that a lot of people have about these accounts. So I think this is really relevant towards different demographics, people at different income levels, and walk through how to think about these accounts, how to prioritize them, and make the best use so you could save better and invest better.
Correct.
Great. So let's jump right in. The first account on the docket is the tax-free savings account, the TFSA.
Yeah, so the TFSA, you take your after-tax dollars and you invest in this account. The contributions are not tax deductible, however, they grow tax-free. So what that means is whatever money you put in, whatever capital you invest, and whatever income you receive in that account and whatever growth in that account, you could take all of it out tax-free. You won't pay a dime in tax. So you have to be 18 years old to invest in this account. And this account was introduced in 2009, and the government basically has given everybody the same amount of room each year to invest in the TFSA. So depending on when you turn 18 years old, that's when you would start accumulating this room that the government's given you. So if you were 18 years old in 2009, you'd basically have the max amount of room to invest in the TFSA, which is now $102,000. So if you were 18 in 2009 and you've never invested in a TFSA and you open one today, you could invest $102,000 in the account.
That's really great, Jackson. So the room for 2025 is $7,000, and every year the government sets a new number. So historically it was $6,000 and then it was $6,500, and every so often they will increase it for inflation and all that. So investors should be aware of what the new room is. You have $7,000. And this is a really powerful one where now we find a lot of clients, a lot of investors will have more and more money in a TFSA where it was a smaller slice of their wealth earlier. This will be a really big instrument for people's retirements down the road. This could be $500,000 in 20 years. And that really helps investors. It helps Canadians, and it's tax-free. You don't have a lot of tax-free options for investing in Canada. So it's a wonderful account. So Jackson, what are some common misconceptions about the TFSA?
So a common misconception I would say is that people sort of treat it as a regular savings account. It is in the name, tax-free saving account, but some people will put money in there but not invest it. And so it kind of takes away from the actual power of the tax-free growth, because that is where the power of it comes from. It's letting it compound over 20 years tax-free. It is still a very useful account for having short to medium term liquidity. And what I mean by that is if you want to buy a bigger ticket item in 2 years from now, it's still useful to have short-term liquidity, but still invest into something. Choose the right asset mix in the account, but still invest your money as it will come out tax-free.
Yeah, that's exactly right. It's a really dynamic account. It's a lot more flexible than a lot of other accounts that have more strict rules, but it's a really good point. It's good for a lot of purposes, but people miss out, I find, a lot on the real power of compounding tax-free. People use it as a savings account, and it's really frustrating. And I will really shame the government here. This is a marketing issue. This is a name issue. I think savings account is it's misleading. Anyway, but really important. So Canadians should really take advantage of this account.
So let's move to the next account here. We're talking about the RRSP. Lawrence, what is the RRSP?
So the RRSP is the Registered Retirement Savings Plan. So this is the granddaddy of all registered accounts in Canada. It's been around for decades. This, for a lot of investors who are probably listening, this was the only option other than a taxable account back in the day, 2000s, 90s, and prior. So the RRSP, unlike the TFSA, the room is a product of your income. So what that means is that your room is calculated as 18% of your previous year's earned income. So you don't get an allotted amount like the TFSA from the government. It's the higher your income, the higher your room, with a maximum of, for this year, 2025, $31,560.
So if I understand correctly, you take the lesser of the 18% of your earned income or the maximum amount that you can contribute?
Correct.
Okay,
yeah,
awesome.
Absolutely. So what is earned income? Earned income for most individuals is employment income, self-employed income, and rental income. There are some other types of incomes that count, and investment income does not count as earned income. So for most people, it's their salaries. So let's walk through the benefits of the RRSP now. There are 3 benefits of the RRSP. The first one is the tax deduction in year 1. Every dollar you put into the RRSP reduces your taxable income by $1. You benefit from tax deferral. From the year of contribution, it stays in the investment account and is untaxed while in the account. However, there's no free lunch, and at the end, money has to come out, which brings me to my third benefit, is benefiting from the difference in your tax rates when you contribute versus when you retire. Now, I may have lost people here. When you're working and you're earning a salary and you're contributing to your RRSP, you're reducing your taxable income by that deduction. And in theory, for most individuals, their taxable income in retirement will be lower. So you're pulling it out at a lower rate and you're getting deduction at the higher rate. That difference is where the benefit comes from.
Okay, awesome. Yeah, no, those are 3 amazing benefits to the account. Can you just walk me through on a high level what the home buyers plan is? Because I know there was a material change in that this year.
Yeah, so the home buyers plan is the one exception to the rule where the standard for the RRSP is it's for retirement, right? You save money in your working years and it's your own personal pension plan when you retire. There's one exception on pulling money out early, and that's for buying a home, for your first home. So previous to 2024-5, the home buyers plan was $35,000, meaning you could take out up to $35,000 per individual to buy a home, and then you have a payment plan to repay yourself over a fixed amount of years. So it's like a loan to yourself. Now that room has gone up in 2024-5 to $60,000 per person. This is an effort to help people in saving for homes and using their savings to purchase properties in Canada.
Okay, awesome. And what is one of the biggest misconceptions with the RRSP?
Yeah, so this is a really interesting one. We see this with plenty of clients and peers I talk to. People see the tax refund they get. So if you put, let's say $20,000 into your RRSP and you're earning $100,000, you reduce your income by $20,000. That's quite material. So you're getting that times your marginal tax rate back when you file your taxes. So you're getting a big refund. And you see that as a free lunch and you go and spend it, or you buy your car or vacation.
It's not cash in the bank though, right?
No, it's not. It's not. So what you must do to take advantage of the full power of this account is to reinvest that tax refund, because if you don't, you're really exchanging 4 quarters for $1. You're not taking advantage of the difference of your current marginal rate when you're working versus your generally lower marginal rate when you're retired. So to make that really work and to have the power of the account working for you, you really should reinvest your tax refund. So this account is best for certain types of individuals. So Jackson, who's this account best for?
Yeah, the RRSP is generally best for people who are earning a moderate to high income. If you think that your marginal tax rate right now during your working years is higher than what it will be during your retirement when you actually have to pull money out of the RRSP, then it's typically suitable for you.
Yeah. So when you say moderate income, like what general range should investors be thinking about on really prioritizing this account for?
Yeah, about $50,000 or $60,000 or upwards of that.
Yeah, no, I think that's great. So I think for a lot of individuals, if they're lower income, maybe they're starting off, I think a TFSA is a wonderful option. Once your income really starts hitting that 50, 60,000, it starts making more sense to prioritize the RRSP because that tax deduction is that much more powerful. And as your income grows over your years and your higher and higher income, hopefully, the power of that deduction become more and more important. So let's move on to the next type of account, Jackson. What's next on the docket?
Yeah, so we're now talking about the RESP, Registered Education Savings Plan. So what this is an account basically to save for your kids' education down the line for post-secondary education. So the lifetime maximum contribution room for each beneficiary is $50,000. The contributions are not tax deductible. However, they're in a way tax deferred. So you can open an account as soon as you have kids, and you can start contributing as soon as you have kids. So the way this works is with each contribution, you are granted a government grant from the federal government as well as the Quebec government, if you're in Quebec. And so the way that works is when you contribute up to $2,500 in the account, you receive 20% return basically in grant from the federal government and 10% return in grant from the Quebec government. So this equals on a $2,500 contribution, $500 of federal grant and $250 of provincial grant.
So that's a really big one. So this is something that you won't get with other accounts. You're getting free dollars from the Canadian government for your contributions. You can't beat a guaranteed 20% return via the grants guaranteed by the governments. So if you put in $2,500 per child per year, you get the maximum grants, right?
Exactly, yeah. And once you contribute more than $2,500 in a year, that additional money will not get you any additional grants. And so the maximum grants that each beneficiary could receive is $7,200 of federal grants and $3,600 of provincial grants. And so the way that works is you make the contribution, you receive the grants. Once your child is in post-secondary education, then you start withdrawing the money from the account. And the way the taxation works on these withdrawals is it's sort of split up into two buckets. You have your contributed capital, which you, the parents or grandparents or whatever, have contributed to the account, which comes out tax-free. But the grants and the income, so the growth of the investments, that is taxable to the beneficiary.
So to the child or the student?
Exactly, yeah.
Okay. So what I've learned in that zone where the child is in school is if you plan for these things correctly, these withdrawals when these kids are in school can be virtually tax-free, but you need to have careful planning now. So what that means is if you're taking from the income and the grants while the kids have a low income, they're in university, they're maybe have a part-time job, you could fill up those lower zero tax brackets when they're in school to prioritize those buckets of the RESP and leave the principal, for example.
Exactly. Yeah, that's the optimal strategy to do it, is to withdraw first the income and the grants. And then later on, of course, if you need it for the education, then you could pull out the capital.
Yeah, that's what it's there for.
And if not, the capital can go back to the parents. It's as you please because it's tax-free, essentially.
Exactly. So this is a really nice one. Basically, the main takeaway for this one is if you have children and you believe or want them to continue their education beyond CEGEP or high school, this is a wonderful strategy here. There are other types of trades and other education programs that do count as post-secondary, so it's not limited to only universities. But the big thing is you want to start early. When the kids are born, you want to start putting money in this account to get the grants early, to make sure you get all the grants that are available to you and have money carved away growing tax-deferred or maybe even tax-free for your children.
Yeah, exactly. And also, we're covering this on a high level. There's so many details to this account, a lot that you would benefit from knowing for. So we're going to actually do a podcast episode on the RESP in the coming weeks. So please stay tuned for that one, as it's going to be loaded with great information. So moving on to the next account, Lawrence, we're doing the RDSP now. Can you explain us what that is?
The Registered Disability Savings Plan. Now, this is something that is not as well known. A lot of Canadians haven't heard of this account. I did 2 pretty detailed episodes on this in mid-2024, late 2024. So if you think you may be eligible, highly recommend you listen to those 2 podcasts, one on the tax credit itself and the other on the investment account. And Jackson was on that episode with me, very detailed. So the RDSP is an account for people with disabilities in Canada. So if you qualify for the disability tax credit, which is a credit on your income tax returns, you could open this registered account and for yourself or for a loved one, help them save for their life, for their retirement, for the living expenses. So this is a newer account. It's a lesser known account, but the high level information is that you could put up to $200,000 into this account. The contributions are not tax deductible, but like the RESP, there is grants to be had as well. And the maximum grants that can be received is up to $70,000 per beneficiary, and an additional $20,000 if the beneficiary and the family are low income.
That's huge. That's tremendous.
Yeah. So that's a lot of money on the table for those who can't qualify, and that's free money from the government. These plans exist for people who need it. So I don't want to go too detailed here, but there are a lot of different types of disabilities that may not be what comes to mind that may qualify. A perfect example is type 2 diabetes. You may know someone who has diabetes, they will be eligible for this types of account, even though they're functional, you may be working or in school. So there's a long list. We actually have a resource on our website in that podcast episode. It's a document that gives a ton of examples on different types of disabilities and how they qualify. It's a great program. So I'm going to leave it at that for this episode.
Yeah.
Jackson, what's next on the docket?
So now we're talking about the FHSA, the First Home Savings Account. So this is a new account that came into fruition in 2023. And the purpose of this was to help young Canadians, or first-time home buyers for that matter, save up for a house so that you can then withdraw the money from this account and buy a home. So what this account is, the main highlights are: picture if the TFSA and the RRSP were blended together and you get the best of both worlds. So the contributions that you make into this account are tax deductible and it grows tax-free. So all the money that you take out of the account, you do not pay taxes on it if you indeed buy a house with that money.
So that is massive. So this is the first time we've ever seen an account, and a lot of countries would be envious of us, where you have a registered account that's tax deductible on the way in and tax-free on the way out for a home. Huge for investors.
Yeah, I don't think they're envious about our home prices, but
Yeah, absolutely.
No, good point, Lawrence. So yeah, the way the room of this account works is once you open the account, you were granted $8,000 of contribution room, and the lifetime maximum of this account is $40,000. So effectively 5 years worth of $8,000 contributions. If you open the account in 1 year, but you did not contribute to it, the following year, you then have $16,000 of room. So you can carry forward 1 year's worth of unused room, but you can't carry forward 2 years worth.
Yeah, that's a big one. And I'll also add that unlike the TFSA, the FHSA room only starts ticking when you open the account. You don't automatically get that room like the TFSA.
Great point. Yeah. So if you think that you will use this account at some point, but you don't have the money for it right away, just open it either way and start accumulating the room.
Exactly.
So the prerequisites to open this account is you must be a Canadian resident. You have to be at least 18 years old, but younger than 71. You have to have a social insurance number, and you have to be a first-time home buyer. Now, the way they explain the first-time home buyer is you or your spouse will have to have not owned a home that you lived in this year or any of the past 4 years. So this account is very interesting because even if you don't buy a home, if a home purchase isn't on your horizon and you plan to be a renter for your life, this account is still for you because you can contribute into this account up to $40,000, and then eventually you could roll it over into your RRSP.
Yeah, so that's a huge one. And that's also a misconception where you go, you know what, I'm a renter. You could be in your 40s and 50s and say, you know, I'm a renter. This isn't for me. But if you haven't owned a home and you qualify, this is a way of basically hacking the system, so to speak, and gaining up to $40,000 of additional RRSP room because you could roll it into an RRSP. So our major message for this one is if you qualify for this account, it's a no-brainer. It gives you flexibility. If you end up buying a home or it's way down the road, you're not sure, it's tax-free. And at the very least, you're gaining some RRSP room and you roll it into your RRSP.
Yeah, exactly. All right, Lauren, so on to the non-registered account. Talk to me about that.
So the non-registered taxable account. So we've now gone over all the major registered accounts. So TFSA, RRSP, FHSA, RESP, RDSP, okay? If you qualify and you've maxed out all these registered accounts that have tax benefits, any additional savings or dollars will be going to a non-registered account. So obviously these previous accounts will be a priority, but a lot of Canadians may have excess savings and that'll go to a taxable account. So that's how it sounds. You are taxed in different ways based on how the income is produced in this account. So you could invest the same way you invest in other accounts. You buy stocks, bonds, mutual funds, ETFs, whatever. And there's 3 types of taxation in this account. The first one is capital gains. When you sell your investment, you're taxed on the gain, and it's 50% of the gain times your marginal rate. Now, you're also taxed on income. So there's dividend income, which is taxed moderately, somewhere in between capital gains, and interest. The interest income is taxed as regular income. So it is the most severe tax rate for income. So interest is at the highest rate. You have dividends at a moderate rate and Canadian dividends at a better rate. And the most tax efficient would be capital gains.
Awesome.
So I'll leave that there. It's important to be aware of as you get through your working years, your savings years. Hopefully you're able to be at a point where you max your accounts, and that would be the next one up.
Perfect.
So next is the holding company account.
Yeah, so this is an investment holding company account is for a corporation, and it's primarily created to hold investments like stocks, bonds, real estate, rather than conducting the active business operations. So it's basically separating an investment holding company as a different entity from the operating company that actually has the active business in it.
Yeah.
And so the main purpose of this is to generate income with the intention of managing risks and optimizing tax efficiency. And the main benefits essentially is to separate the business operations from the assets to actually limit the liability exposure. The second benefit for this is capital gains deferral when profits are reinvested. So you can do an intercompany dividend from an operating company to a holding company without actually triggering the capital gains tax on it right away.
Absolutely. So this is a big one. So this is really big for business owners. The business is profitable and profits are accumulating in the business. And you want to flush it out, protect it, and invest it. So very powerful, very complex. You would need corporate accountants, and some careful planning is needed for these types of accounts to make sure that taxes are being minimized and investments are being optimized in the accounts, and especially in retirement, how that plays out. Wonderful account. Over the years, the tax benefits of a holding company versus if you invest it personally are starting to shrink. It used to be better, but for a lot of individuals, if you fit this mold, it's a must open, and it's important to protect your assets when possible.
Okay, Lawrence, on to our last account. Which one is this? What are we talking about?
So this is the IPP, or the Individual Pension Plan. So this is a lesser known one. This is a really powerful account for high income earners mainly. So we see it a lot within corporate professionals and business owners, and even business executives who have very high incomes for long periods of time. So what this account is, it's similar to an RRSP, but it functions as an individual, defined benefit plan that'll pay you a consistent income in retirement. So it sounds a lot like an RRSP, but there are some caveats here where the available contribution room for the IPP is greater than an RRSP. So it allows you to save more.
Okay, so that's interesting. So walk me through the main benefits of this account then.
Yeah, so the big ones is that the amount that you can contribute is higher than an RRSP. So if you're high income, you want to save more, gives you more capacity. It's tax deferred growth like an RRSP. And the contributions are tax deductible for the employer. So if you're a business owner and you're topping up the IPP, it's a deduction on the corporate side, which is massive.
Wow.
Yeah. And the IPP functions as a defined benefit. So it gives you reoccurring payments in retirement that helps for planning and for cash flow purposes. And the funds in the IPP are also creditor protected, which is very important as well.
Okay, wow. So basically what you're saying is if you're a business owner with high income and high savings capacity, this account could be super worth looking into.
Absolutely. Now, it is a complex account. You need actuaries to do all the calculations and to administer it. But for those who qualify, it's a very good tool. Absolutely.
Okay, awesome.
So let's wrap up, Jackson. I think this is a really interesting episode for a lot of different types of people. So what are your major takeaways, Jackson?
I think I just have one takeaway, and it's the fact that we're mid-January. It's the start of a new year. It is a great time for everybody to sit down, take a look at their finances, maybe plan a little bit how they're going to save this year, look at the most efficient ways, what works for you, what might be best for you, and take charge of this year.
Yeah, no, absolutely. I think that's very well said. And I think my major takeaway is we hit the highlights. We hit the important general information for a lot of these accounts, but everyone's circumstances are a little bit different. Their goals are different, their circumstances. So it's important to understand how these play a role in your overall finances, in your family's finances. So if you have questions, please reach out. We're always happy to help and make sure you have a grasp on all these things. So with that, thanks for listening, and to next episode.
Have a great year, everyone.
Cheers.
You've been listening to the Empowered Investor Podcast, hosted by Keith Matthews. Please visit tma-invest.com to subscribe to this podcast, learn more about how his firm helps Canadian investors or to request a complimentary copy of The Empowered Investor. Investments and investing strategies should be evaluated based on your own objectives. Listeners of this podcast should use their best judgment and consult a financial expert prior to making any investment decisions based on the information found in this podcast.